In the first week of January 2026, while the world's press focused on Venezuela, no one noticed that the real fracture was occurring silently elsewhere. China reached a position where it controlled 80% of the world's solar panel production and 75% of battery manufacturing over the past 12 months. The United States, meanwhile, solidified its status as the world's largest oil state by producing 13.5 million barrels of oil per day. Two rival superpowers were investing in two completely different visions of the energy future, one in molecules, the other in electrons. This divergence was far more than simple trade competition. There was a reality not yet fully grasped in Washington's decision centers. The definition of energy power was changing, and this change was silently eroding America's geopolitical advantage. Investments in oil wells were still enormous, but the infrastructure chains controlled by Beijing were building a different kind of power, physical, irreversible, and directly determining the fates of nations. The problem was this: the United States was maintaining an energy model built over 150 years. The oil fields in Texas, the refineries in the Gulf, the global tanker networks, all were the backbone of the fossil fuel economy. And this backbone was still the world's most powerful economic weapon, until it wasn't. China's approach, however, was based on an opposite philosophy. Beijing understood a decade ago that the energy system of the 21st century would run on electricity, and it had been moving silently ever since. Solar panel factories, lithium refineries, battery production facilities, each was established through carefully planned steps. China's current control of rare earth element capacity had reached 70%. Without these elements, it was impossible to produce electric vehicles, wind turbines, or artificial intelligence sensors, and the world's need for these elements was growing exponentially every year. What was interesting was that this was never presented as a global green revolution. China's official rhetoric spoke of combating climate change, but the real strategy operated at a much deeper level. This wasn't a natural evolution of China's industrialization model. This was controlled power redistribution. China's 5-year plans were written with the electron economy at the center, and each plan set more ambitious targets than the last. The 15th 5-year plan, prepared for the 2026-2030 period, envisioned multiplying electric vehicle production, battery storage capacity, and clean energy technology exports. The most dangerous dimension of this strategy was that global infrastructure was becoming increasingly dependent on Chinese components. Pakistan doubled its electricity capacity by importing enough solar panels from China over 6 years. Bangladesh initiated mandatory solar panel installation on public buildings. Dozens of countries in Africa and Latin America were building their own energy storage with Chinese-made batteries. None of these countries possessed China's technology production power, but all were connecting to China's supply chain. And this dependency was the modern version of the influence Washington built through oil over a century, quieter, more permanent, and less visible. America's attempts to reverse this trend fell far short of expectations. Customs tariffs, security concerns, national security arguments, none were sufficient to break China's cost advantage. For example, the cost of a Chinese-made solar panel had dropped to less than half that of its American or European equivalent. Electric vehicles were selling at similar price differentials. This wasn't just about cheap labor. Because China controlled the entire supply chain, it maximized benefit from economies of scale. Additionally, Through state subsidies, local demand incentives, and export support, it could suppress prices in the world market. The West's response typically remained limited to protectionist measures. The European Union was imposing additional tariffs on Chinese electric vehicles. America was banning certain Chinese components on national security grounds. However, these measures did not affect developing countries. On the contrary, as Western tariffs increased, the developing world turned even more rapidly to Chinese technology, and this deepened China's dominance over global infrastructure. Beijing was slowly becoming the architect of the energy systems of the world outside Europe and North America. But the real breaking point had not yet emerged. America's oil dependence was not just an economic choice. It was defended as if it were a geopolitical necessity. The Permian Basin was producing more than 6.5 million barrels per day, representing more than half of America's total oil production. These fields in Texas and New Mexico were seen as the stabilizer of global energy markets. Washington defined energy independence as a prerequisite for military and economic freedom, but this definition ignored the fact that the world's energy architecture was changing, because the rest of the world no longer viewed oil the same way. Countries like India, Pakistan, and Bangladesh had begun to assess remaining dependent on oil imports as a strategic risk, and the alternative offered by China made more sense both economically and security-wise. An economy running on electricity was independent of oil embargoes, price shocks, and naval blockades. The sun rose every morning, and electricity could be produced locally. China was processing this message delicately. While Washington tried to sell the world 20th century energy sources, Beijing was offering 21st century infrastructure. And this offer was building power not through soft power, but through physical control. China's solar panel factories, battery production facilities, rare earth refineries, all were strategically important physical assets. When a country purchased solar panels from China, it wasn't just buying a product. It was entering China's technology, standards, and ultimately China's sphere of political influence. This was a new power dynamic that the Pentagon was trying to understand. Hard power no longer meant just aircraft carriers or missiles. Hard power meant controlling global supply chains. However, this reality had not yet been fully grasped in Washington. In January 2026, the U.S. Energy Information Administration announced that oil production for 2026 would remain around 13.5 million barrels per day. This could be considered a high number, but what stood out was that production was no longer growing. The growth trend that had continued for 4 years was ending. Oil prices were falling from $65 per barrel in 2025 to $51 in 2026. This resulted from both oversupply and changes in global demand dynamics. Because world oil demand growth was no longer what it used to be, India was the largest source of new global demand growth, but even India was diversifying its energy mix. The possibility that China's own oil demand had peaked was beginning to be taken seriously. Electric vehicle sales were rising at tremendous speed. Solar and wind energy were meeting 84% of China's electricity demand growth. And in the first half of 2025, clean energy production had exceeded China's electricity demand growth. This meant that fossil fuel use in China was actually beginning to decline. This wasn't happening only in China. Thailand, Vietnam, Indonesia, all of Asia's growing economies were following a similar path. And this path heralded a world in which America's oil-centric energy vision was becoming increasingly marginalized. Even the Gulf region's oil states understood this. Saudi Arabia became the world's fourth largest importer of Chinese solar panels in 2024. Riyadh planned to electrify its own economy so it could export more oil. But was this strategy sustainable in an already shrinking oil market? The problem was this: oil states were still competing for a declining market, and China had already built the infrastructure for a growing market. China's clean energy sector comprised more than 10% of the country's gross domestic product in 2024. This wasn't just an industrial sector, but one of the economy's driving forces. Electric vehicles, solar panels, wind turbines, all were the lifeblood of the Chinese economy. And looking outward, these sectors' global market share dominance was almost absolute. 70% of the world's electric vehicle production came from China. 85% of solar panel production, 75% of batteries. These figures didn't just reflect the current situation. When projections were made for future years, the picture was even more striking. China's planned solar panel production capacity for 2030 was 65% higher than the 2030 global solar energy installation target in the International Energy Agency's net zero roadmap. In other words, China had capacity to produce more solar panels than the world needed. This meant oversupply, and oversupply meant price pressure, and price pressure made competition virtually impossible. America and Europe had efforts to establish their own solar panel and battery production facilities. But these facilities couldn't achieve economies of scale. Costs were 2, 3, even 5 times higher than China's. Even government incentives couldn't close this gap, because China controlled not just the final product, but the entire supply chain. From polysilicon production to battery chemicals, from rare earth elements to assembly lines, everything occurred within China. This wasn't just economic efficiency. This was strategic design. And another dimension of the design was financing. China wasn't just selling technology to developing countries. It was also providing credit. Beijing was financing infrastructure projects, and these projects used components from Chinese companies. This was a new version of the classic Belt and Road Initiative model. But we were no longer talking just about highways and ports. Now we were talking about power grids, solar energy farms, electric bus fleets, and each had a lifespan of 40, 50 years. This meant that when a country transitioned to China's energy infrastructure today, it would remain tied to China's technological ecosystem for the next half-century. Spare parts, software updates, technical support, all would come from Chinese companies. This was the digital, electric version of the influence mechanism Washington established through oil, but with a difference. Oil sales were a relationship that could be renegotiated each time. Infrastructure dependency was permanent and difficult to reverse. But there was another point in this process that had not yet been adequately analyzed. When America's intervention in Venezuela occurred in the first days of January 2026, the official justification was drug trafficking and regime change. But everyone knew the real reason was oil. Venezuela had the world's largest proven oil reserves, and these reserves had not been operated at full capacity for years. If Washington seized control of these reserves, it could influence global oil supply, manipulate prices, and gain a strategic advantage. But right at this point, there was a contradiction. While America was conducting military operations for oil control, China was silently becoming the architect of the world's energy infrastructure. While Washington was making a 19th-century-style imperialist move, Beijing was building the power dynamics of the 21st century. This wasn't just a tactical mismatch. This was a clash of strategic visions, and time would show which vision would prove correct. But the signs were already clear. China's electric vehicle exports increased by 46% in the first 11 months of 2025. Energy storage system exports grew by 51%. Clean energy technology exports reached $20 billion in August 2025. This was a new record. And this wasn't just hardware sales. China was also exporting expertise. Chinese engineers were running energy projects in dozens of countries from Africa to Latin America. Chinese companies were establishing joint ventures with local partners. And these partnerships were embedding China's technological standards at local levels. As a result, the language of the world's energy system was beginning to speak Chinese. From battery chemicals to charging standards, from power grid protocols to solar panel installation techniques, everything was being shaped by the norms China set. This was a phenomenon called norm-setting power in geopolitics. America established this power in the 20th century through oil, the dollar, and financial systems. China was building the same power in the 21st century through the electron economy. However, the end of this story had not yet been written, because the United States still had cards in hand. Technology, innovation, capital markets, military power, none of these had disappeared. But the question was how effective these cards were in the energy transition. America was ahead in the artificial intelligence race, but artificial intelligence data centers consumed tremendous amounts of electricity. And who would provide this electricity? China was already far ahead in battery storage and electricity generation technology. New artificial intelligence companies, established in Silicon Valley, faced enormous energy needs to process their data. And the only way to provide this energy without carbon emissions was through clean energy technologies. But when we said clean energy technologies, we were talking about supply chains dominated by China. So America's artificial intelligence leadership was ironically becoming dependent on China's energy technologies. This was a reality Washington had not yet fully accepted. Pentagon strategists assessed China's technological rise as a military threat. But economic dependency was more insidious and more permanent than military threat, because a war could end as it began. But when an economy was condemned to its own supply chains, reversal took decades. And right at this point, the time factor came into play. China's electric vehicle fleet was rapidly expanding. 3 out of every 4 electric vehicles were produced in China in 2024. This ratio would continue to increase in 2026. China's battery storage capacity was larger than that of America and the European Union combined. Solar panel installations were breaking record after record. Wind turbines were forming giant energy parks in China's northern regions. And all of this was supported by a rapidly expanding domestic market. Because China wasn't just producing for export, it was also electrifying its own economy. Electricity's share in final energy consumption had exceeded 32%. It was increasing by about 1 percentage point each year. Fossil fuel consumption had been declining since 2015. China was rapidly becoming an electro-state, a country whose economy relied on electricity, becoming independent of fossil fuels and securing energy through domestic production. America, however, was still maintaining the petrostate model. A large part of its economy relied on oil production, refining, and petrochemical products. Texas, Oklahoma, Louisiana, These states' economies revolved around fossil fuels, and this economic structure also shaped political decisions. Washington legitimized every investment in oil as strategic necessity. But this necessity seemed like one the rest of the world no longer shared, because the developing world was choosing an electric future. From Pakistan to Bangladesh, from Kenya to Peru, all were adopting solar panels, batteries, electric vehicles, and what they all had in common was purchasing these technologies from China. Western tariffs couldn't stop this trend, because Western alternatives were twice as expensive as China's. This was a matter of economic logic, and developing countries were choosing economic logic. However, there was another layer to the story. China's electrostate strategy wasn't limited to just technology sales. It was also supported by financial instruments. China was offering low-interest loans to developing countries. These loans were used in financing infrastructure projects, and these projects were naturally built with Chinese components. As a result, borrowing countries were becoming both financially dependent on China and technologically drawn into China's ecosystem. Was this a new form of colonization? It was possible to answer the question from different perspectives. But one fact was clear. China was expanding its sphere of strategic influence using economic tools. And this expansion was occurring silently and systematically, without using military threats. What would America's response to this be? Washington had taken various measures in recent years to slow China's technological rise. Restrictions on semiconductor exports, bans on technology transfers, sanctions on Chinese companies, all had been implemented. But similar restrictions didn't work in clean energy technologies, because solar panels or batteries weren't as sensitive technologies as semiconductors. These were now widespread, relatively simple, and copyable products. And China produced these products at such a scale that it had left its mark on the global market. There was also another dimension: climate change. The world had to reduce carbon emissions, and the fastest way to reduce carbon emissions was to spread clean energy technologies. But these technologies came from China. So climate goals were paradoxically increasing China's global power. While the West tried to combat climate change, it was simultaneously helping China's strategic rise. This was an equation Washington needed to solve. But a clear solution wasn't yet visible. As time progressed, the question became sharper. Would the 21st century be the century of electrostates or petrostates? The answer would become clear within the next 5 to 10 years. But for now, trends pointed in China's favor, because the electric economy wasn't just an energy issue. It also meant the electrification of mobility, industry, and everyday life. Electric vehicles, electric heating systems, electric transportation networks, all of these formed an ecosystem feeding off each other. And this ecosystem was completely independent of fossil fuels. The sun rose every morning, wind blew every day, but oil could be subject to geopolitical crises, embargoes, price manipulations. This was a revolutionary change in terms of energy security, and the countries that understood this change first would be the winners of the 21st century. China had seen this reality a decade ago, and now it was implementing this reality on the ground. America, however, was still operating within 20th century power paradigms. The Venezuela operation was one of the most striking examples of this. Washington was using military force for oil control, but the world no longer viewed oil the same way. Europe, meanwhile, was caught between these two powers. France, Germany, the United Kingdom, all three had entered 2026 with weak, unpopular governments. Right and left, Populist movements were eroding these countries' political centers, and the Trump administration's direct interference was making the situation even more complex. Europe's capacity to fill its own security vacuum was diminishing. America's retreat was leaving Europe vulnerable, and the hybrid war between Russia and NATO was shifting from the trenches in Donetsk to Europe's energy infrastructure. In this context, Europe's energy dependency was becoming a critical vulnerability. Europe had been dependent on Russian natural gas for many years. Now it faced the risk of becoming dependent on China's clean energy technologies. Germany's China strategy reflected these concerns. Berlin was preparing an action plan to reduce dependence on China for critical raw materials. But how realistic was this plan? Because China controlled 70% of rare earth elements, and without these elements, Europe's green transition was impossible. The European Commission would revise the Cybersecurity Act in mid-January 2026. This revision would open the door to EU-wide cybersecurity restrictions, and everyone knew that the target of these restrictions was Chinese technologies. But the problem was that Europe had no alternative suppliers. Restricting Chinese technology meant slowing Europe's own green transition. This was a paradox that needed to be solved. And this paradox wasn't unique to Europe. The entire world was in the same dilemma. It needed Chinese technology to reach climate goals. But depending on Chinese technology threatened strategic autonomy. This dilemma was becoming increasingly sharp because China's clean energy investments continued to increase. In 2024, China alone carried out 31% of global clean energy investment, $625 billion. And this investment wasn't just adding new capacities. It also meant research and development. Chinese companies were making 75% of global clean energy patent applications. In 2000, this rate was only 5%. In 25 years, China had not only caught up with the world, but surpassed it. This patent dominance meant that future technology standards would be set by China. From solid-state batteries to hydrogen electrolyzers, from advanced solar cells to electric heavy-duty trucks, the foundations of every new technology were being laid in Chinese laboratories. And this provided not just economic, but geopolitical advantage. But there was another dimension to the story. Water. Half the world's population was already living under water stress, and climate change was multiplying this stress. The Indus Waters Treaty had been suspended. Ethiopia's dam on the Nile had become operational without any binding agreement. China was building the world's largest dam and had no treaty with downstream countries. Water was increasingly becoming a weaponized tool, and the energy transition was making the water issue even more complex. Because the electric economy was a water-intensive economy, battery production consumed enormous amounts of water. Lithium extraction depleted groundwater. Solar panel production required ultra-pure water. The hydrogen economy needed vast water resources for electrolysis. So the world's electric future also meant water dependency, and China understood this reality. Beijing was also investing in water technologies, desalination plants, water recycling systems, advanced irrigation technologies. All were part of China's green technology portfolio. And again, China was offering these technologies to the global market. As a result, China was becoming a global player, not just in energy, but also in water security. This was an unprecedented consolidation of power. At no period in history had a single country controlled energy and water technologies to this extent. America, however, had been late in realizing this strategic shift. Policy debates in Washington still revolved around traditional energy security concepts: oil reserves, natural gas production, refinery capacities, all were 20th century metrics. But Beijing was setting 21st century metrics: battery production capacity, rare earth refining rates, electric vehicle sales penetration, solar panel installation speed. And in these metrics, China was unquestionably ahead. Artificial intelligence investments were making the situation even more critical. In 2024, major technology companies invested more than $400 billion in artificial intelligence data centers. This figure would rise to $1,100 billion by 2029, and much of this investment was financed through debt. OpenAI had postponed profitability until 2030. Anthropic hoped to break even in 2028. So the artificial intelligence bubble continued to inflate without bursting yet. But the real risk was this bubble's dependence on energy. Artificial intelligence data centers consume tremendous electricity, and meeting this electricity with clean energy meant depending on China's supply chains. America's artificial intelligence leadership was thus being condemned to China's energy technologies. This was a strategic trap, and the trap was slowly closing, because a threshold was being approached from which there was no return. When a country built its electric infrastructure with Chinese components, it remained dependent on these components for 50 years. When an economy electrified its energy system, returning to fossil fuels was not practical. When an industry produced according to Chinese standards, standard changes required astronomical costs, so choices were becoming irreversible, and the world was silently making these choices. As Pakistan built its electricity system, as Kenya modernized its power grid, as Peru deployed its electric bus fleet, all were choosing Chinese technology because that was economic logic. But economic logic contradicted strategic logic. Washington was trying to resolve this contradiction, but the solution was not in sight, because the alternative America could offer either didn't exist or was too expensive, and the developing world couldn't afford expensive alternatives. This wasn't just about technology. This was about rewriting the world order. The order built since Bretton Woods was based on oil, the dollar, and American military power. But would the new order be based on electrons, the yuan, and Chinese technological dominance? The answer wasn't yet clear, but trends were making this question increasingly urgent. Petrostates were entering a twilight zone. Saudi Arabia, the United Arab Emirates, Kuwait, all were making plans for post-oil futures. But how realistic were these plans? Because their economies had relied on oil revenues for 50% or more for decades, and the permanent decline of oil revenues was an existential threat. Russia faced a similar situation. Moscow was dependent on energy exports, but Europe was becoming independent of Russian energy. Asian markets were growing, but in the long term, Asia too would electrify. Russia's future revenue streams were a big question mark, and the Venezuela operation looked even more ironic in this context. America was using military force for control of a declining market. But control of a declining market didn't provide increasing power. China, however, was the architect of growing markets, and this showed the difference in strategic vision. The story didn't end here, because China had its own risks too. The Chinese economy could enter a deflationary trap. Overcapacity, falling prices, shrinking profit margins, all could trigger an economic crisis. And if China's domestic market contracted, the entire global clean energy sector would be affected. But for now, China was managing these risks. Government stimulus, infrastructure investments, export incentives, all were keeping the economy afloat, and the global expansion strategy was providing an outlet for excess capacity. America, meanwhile, was still searching for its response. Should it compete with China in clean energy technologies? Should it focus on next-generation technologies like fusion or advanced nuclear? Should it use economic sanctions to slow China down? Should it form alliances with Europe and allies? All of these questions remained unanswered because none had clear solutions. Competing with China required decades of investment and a restructured supply chain. Next-generation technologies were still years away from commercialization. Economic sanctions could backfire and hurt American companies. Alliances were fragile, and European commitment was uncertain. So Washington was caught in strategic paralysis. And as Washington hesitated, Beijing continued to move forward. The global energy map was being redrawn, and the redrawing wasn't happening through grand announcements or diplomatic conferences. It was happening through factory constructions, infrastructure projects, technology transfers, and financial agreements, silently, systematically, irreversibly. This was the anatomy of the silent power shift, and this shift was approaching a point of no return. Because once infrastructure was built, once standards were set, once dependencies were established, reversal became exponentially difficult. The world was locking itself into a Chinese-designed energy future, one installation at a time. The question wasn't whether this would happen. The question was whether anyone would notice before it was too late. Because the signs were all there. They just required looking in the right direction.